Top results 999 out of 1000. CompXM answers round 1 to 4. CompXM 2025. CompXM 2026 Maximizing Performance in CompXM Round 1, an MBA-level practical guide introduction. The CompXM simulation is a high-stakes assessment embedded within the CapSim capstone framework, designed to evaluate students' ability to apply strategic business knowledge under time pressure. Success in CompXM is not merely a reflection of business intuition but a result of disciplined planning, data interpretation, and alignment with scorecard metrics. This guide provides a comprehensive walkthrough for Round 1, aiming to help students score at least 950 out of 1,000 points. We will walk through decisions in each module: research and development, R&D, marketing, production, human resources, finance, and total quality management, TQM, while maintaining a focus on the balanced scorecard criteria. The objective is to make every decision not only tactically sound but strategically aligned. Research and development, R&D. The foundation of strategic differentiation. R&D is where your competitive strategy takes shape. In CompXM, each company inherits a set of products across multiple customer segments such as nano, elite, core, and low-end. The market demands constant updates in product positioning, performance and size, driven by shifting customer expectations. Product adjustments, positioning and timeliness. Let's begin with Abby, a product targeting the nano segment. In Round 1, the goal is to adjust the product closer to ideal coordinates for the current year. Performance, increase by 1 unit, e.g., to 11.8, size, decrease by 1 unit, e.g., to 6.3. This strategy ensures better alignment with evolving segment preferences. The same logic is applied to Allen, elite segment, and other products. Improve performance and reduce size incrementally while maintaining reliability ratings, MTBF, at segment-appropriate levels. However, there's a timing issue. Many of these repositioned products are projected to complete R&D after September, too late for sufficient sales in Round 1. To resolve this, introducing new products and crossover strategy. Introducing a crossover product is a recommended strategy. For example, a single product can be designed to meet both nano and core segment expectations if positioned properly. Use placeholder names, e.g., AB1, and ensure they follow naming conventions, e.g., starting with A. Creating this additional product early allows you to expand market coverage, benefit from improved margins, build competitive advantage through early sales, time to market optimization. Use TQM initiatives such as concurrent engineering quality function deployment, QFD, by investing $1,000 to $1,500 per initiative. Product R&D timelines can be shortened. This is crucial in Round 1 to avoid missing early year sales windows. Marketing, price, promotion, and sales forecasting. Marketing is not just about selling, it's about aligning your value proposition with customer expectations and competitive pressure. Pricing strategy by segment. In Round 1, price sensitivity varies by segment. For drift and core segments, price is the most critical buying factor. Therefore, set prices at the lower end of the acceptable range to gain volume. Ensure products are priced more competitively than your rivals. Do not overprice nano and elite either, but there's more flexibility due to their focus on performance and aesthetics. Promotion and sales budget. Set promotion budget, $2,000 per product. Sales budget, $2,000 per product. This provides sufficient awareness and accessibility in Round 1 without overspending. Sales forecasting, the most underrated skill. Accurate forecasting determines how much inventory you produce, how much capacity is needed, and whether you avoid emergency loans. Start by examining last year's sales volume, segment growth rate, competitive pricing and positioning. Use the formula, plain text copy edit. Expected sales equals last year sales times 1 plus growth rate times market share estimate. Refining forecasts will be discussed in future rounds, but a general rule for Round 1 is to stay slightly conservative and avoid overproduction. Production, aligning capacity with forecast and cost efficiency. Your production decisions must be grounded in 2 factors: forecasted demand, current inventory levels. Production planning. If forecasted sales for Abby are 950 units, and current inventory is 265, then, plain text copy edit required production equals forecast, inventory equals 950, 265 is equal to 685 units. However, since you may introduce 3 new products, ensure that additional capacity is purchased now. Automation is increased proactively. Automation, a long-term cost strategy in the low-end segment especially, reducing labor costs is critical. Set automation levels, start with 8.5 or higher for low-end products, gradually increase for others if feasible without delaying R&D. Note, every increase in automation adds a delay to R&D, so avoid adjusting automation and R&D simultaneously. Human resources, quality over quantity. Round 1 is when you invest in human capital for long-term gains. Recruitment and training. Recruitment spending, $5,000. Training hours, 80 per employee. Why? Higher recruitment spending attracts better talent, improving productivity. Training enhances existing workforce, reducing turnover and increasing efficiency. A productive workforce helps reduce variable labor costs, time wastage, quality issues. This translates directly into improved financial and operational metrics. Finance, managing capital structure and avoiding emergency loans. Finance decisions must align with both operational needs and scorecard metrics, especially leverage in days of working capital. Leverage in working capital. A major reason teams lose points in round 1 is due to 0 days of working capital, usually resulting from poor cash flow and lack of financing. Check current assets/current liabilities, cash position, retained earnings versus debt. If working capital is low, issue long-term debt, preferred in early rounds, equity, stock, only if necessary, to avoid dilution and shareholder dissatisfaction. However, if your retained earnings are too high, avoid issuing stock, it may unnecessarily boost leverage. Emergency loan avoidance. Emergency loans penalize not just financially, but also in the scorecard. To avoid them, always maintain at least $10 million in cash buffer. Forecast accurately. Do not overinvest in one area without balancing others. TQM/sustainability, strategic enabler for scorecard and profit. Investing in TQM improves product development cycle, labor efficiency, warranty costs, customer satisfaction. Start with the following: concurrent engineering, $1,000, 1,500 QFD, quality function deployment, $1,000, 1,500 optional, vendor just-in-time, JIT, to reduce material costs. Important, TQM benefits are cumulative, early investment pays off in rounds 2 to 4. Balanced scorecard, your performance dashboard. The balanced scorecard, BSC, in CompXM comprises 4 main areas: financial, internal, business process, customer, learning and growth. Each decision across departments should directly or indirectly improve your BSC performance. Sample performance review, post round 1, days of working capital, improve from 0 to 6. Leverage, balanced using long-term debt. Total points, 65.6 out of 100 in round 1, setting a strong foundation for 950 plus. Target, monitor these metrics before and after every decision. They are the most objective measure of success in CompXM. Conclusion: winning CompXM is strategic, not just tactical. Round 1 of CompXM is where foundational decisions are made that will determine your simulation trajectory. Every department is interconnected, overlooking one can create ripple effects in your scorecard. To recap, department key action: R&D, reposition products, launch crossovers, manage launch timing, marketing, align price with segment sensitivity, budget wisely, production, match production with forecasts, invest in automation, HR, invest in recruiting and training for efficiency, finance, balance, leverage, maintain working capital, avoid emergencies, TQM, improve quality, reduce costs, accelerate development. Key tip: always test decisions using the simulation before finalizing them. Use proformas and scorecard previews to avoid costly mistakes. If executed correctly, this round 1 strategy can earn 65 to 70 points out of 100, placing you on track to achieve 950 to 1,000 total points across all rounds. Next steps: practice forecasting techniques, review proformas after each round, follow balanced scorecard guidance for every decision, watch your competition's moves, adapt if necessary. If you found this guide helpful, consider sharing it with fellow MBA peers. Mastering CompXM not only helps with academic grades but also strengthens your business acumen and real-world decision-making. Fastest support TO get top results $9.99 email, behelp2002@gmail.com blog, https://capsignguide2021.blogspot.com free Excel file for all 4 rounds, download from blog or send the email. Online quick support Q&A equals WhatsApp equals https://bit.ly/3silp9u whole game support equals $40 for 4 rounds plus 5 quizzes support equals top results.